while you're probably, hopefully, experiencing really good gains in the market because it's been extremely easy, throw a dart, everything's going up. A lot of you probably in the back of your mind are worrying about, should I start playing some defense? What does the market look like right here? Is the market overvalued? And in an overvalued, overpriced stock market, where we know there's some headwinds that are going to be coming our way, what are some of the things that we need to do? Welcome to Wealth Talk this week. And what I wanted to do is get back to something that I'm pretty well known for, that I spend a lot of my time on, and that's talking about the stock market. So a lot of you guys are following me because you're new investors, and some of you really just got into the market during the pandemic. Last year, things were shut down. A lot of people opened online trading accounts. Lo and behold, we got into one of the biggest bull markets in our history. So a lot of you now, for the first time, are making ETF investments, stock investments, maybe investing in mutual funds or inside your 401k, and you're trying to get some education on, how do I navigate this? You've heard the stories about the big crash in 2000. You saw what happened in 2008, 2009. Just in 2020, during the pandemic, we saw the market drop just about 40% in a matter of weeks. And so I know a lot of you, while you're probably, hopefully, experiencing really good gains in the market because it's been extremely easy, throw a dart, everything's going up. A lot of you probably in the back of your mind are worrying about, should I start playing some defense? What does the market look like right here? Is the market overvalued? And in an overvalued, overpriced stock market, where we know there's some headwinds that are going to be coming our way, what are some of the things that we need to do? So I wanted to spend about 10 minutes today talking about a game plan, talking about a roadmap, giving you some ideas, strategies, and thoughts from someone who's managed money, traded for well over 20 years in all different types of environments, bear markets and bull markets, up and down, and understanding, how do you manage risk when that time comes? How do you preserve and lock in some of those gains? And also today, if you have new capital to deploy, which I know a lot of you do, how do you think about investing in the stock market? So when I look at the market today and we look at valuations of the whole market, when I say the market, I'm initially referring to, or essentially referring to, the S&P 500. 500 of the largest US companies out there, companies like Coca-Cola, but also companies like Tesla, Procter & Gamble, ExxonMobil, the biggest, largest corporations, Disney, out there that you could experience, invested in 500 individual names, put into one index, an ETF, the SPY. If you wanted to buy the entire market, you can go and do that for a very inexpensive price. And so that's the first place I'll start. Is this a good time to actually put money just into the stock market itself, or that S&P 500 ETF? What I would say, in my view, it's really not. And so why I say that is because valuations, meaning, let's look at price to earnings ratio. Every dollar that a company is earning, traditionally you're paying somewhere from around 17 to 20 times earnings. You're going to pay towards that lower end. This is over the last 10 years, when interest rates are higher, and you're going to pay towards that higher end when interest rates are lower. Why is that? Well, we always talk about, in my Wealth Academy, we always talk about here on Wealth Talk, about that 10-year bond being the risk-free rate. And whether you're a real estate investor, stock investor, you're always comparing any investment that you're making to the risk-free rate. Why? Because I know today I can give the US government my money, they'll give me 1.3%, and in 10 years, they'll give it back to me. So I know for the next 10 years, zero risk, I get 1.3% annualized paid to me every single year. Or if I gave them $100,000, I'm going to get a check every year for $1,300. Well, $1,300 for a $100,000 investment today, I don't know about you, but I don't get too excited about it. So when I look at the market, I'm willing to pay a little higher multiple for companies that are paying dividends, in a lot of cases, that are twice that. You look at companies like Coca-Cola, Procter & Gamble, a lot of those companies forget the growth. Even if there's no growth over the next 10 years, just the dividend that you get paid to hold that company is almost twice what you're getting from a 10-year bond. So today, you can conceivably make the case to have higher valuations in the stock market. You can see why people are continuing to buy stocks. But when I look at the market today, we're trading at about 22 times forward earnings, meaning what companies are predicted to earn next year. Now, the problem with that is 22 is rather high. Also, Southwest Airlines on Wednesday just came out and they made an announcement saying, we think that earnings in the next quarter are going to actually be lower than what we anticipated. Why? Because of this new strain that we're seeing in the virus that's causing people to change their behavior. This is something I've talked about on Fox, I talked about on CNBC for the last 2 months. This being my biggest headwind, my biggest risk, my biggest concern for the economy. And the economy really is indicated by what the stock market does. As people start to worry, as we hear about new mandates coming out, as we hear about things like mask requirements, limited capacity, people are now canceling events. They're starting to rethink some of their vacations. Once that psychology changes, even if those things haven't impacted you in your state, if you start thinking that's going to happen, you're going to make changes. That's going to predict what happens in the future with your behavior. And now Southwest is already starting to see that pattern happen in their booking numbers. So I'm very worried, just looking at that as one example of what could actually make those projected earnings next year maybe be too high. Also, we still don't know. We have a new administration. What's going on with tax policy? Our corporate tax is going to go from 21 to 28%. Are we going to see the absolute demolishment of long-term capital gains rates, where you could see rates as high as 43% from 15 or 20%? All those things are tremendous headwinds for the market. And so all I'm trying to say now is the market is priced for perfection as a whole of those S&P 500 company names. And that's based off of a relatively rosy prediction of what analysts think for next year. If those things don't happen, if the virus causes things to become much more of a concern, if we see continued supply constraint, continue to spike up inflation, all these things that we're worried about, that could put a dampener on it. So the question is today a great time to go and buy the US stock market? I would say absolutely not. And so what do you do with new capital? Well, the thing about the stock market, it's really a market of stocks. And in those 500 names, or if you look outside the index, there's a lot of companies that, irrespective of what's going on with the virus, irrespective of what happens with corporate taxes, are growing their top line 25, 30% and are going to do really well. We talked about some of these names before, that whether or not things are shut down or opened up are facilitating the way we do business today. None of these are a recommendation to buy. These are companies that I own, some of my clients own. By the time you see this video, I may be in or out of them, but I want to give you our thought process of what we're doing. We talked about companies like Zoom. We talked about companies like CrowdStrike. We talk about companies like Facebook. What do I like about these types of companies? Coinbase is another one. It's really, these are the companies that are the backbone and facilitating this new economy, whether that's work from home for the rest of our lives or whatever it may be. If you look at a company like Facebook, more and more entrepreneurs are opening businesses through Facebook. Also, we know Facebook owns Instagram, they own WhatsApp. If you look at those S&P 500 companies, a lot more marketing dollars are now going to companies like Facebook, because the monetization of social media, influencer marketing is much more powerful than what we've ever seen from traditional media. Oh, while you're working from home, just like what I'm recording on today, Zoom, this is facilitating the way we do business. Zoom is making companies more profitable. It's cutting on travel expense. You're able to now, at our wealth management firm, I have advisors doing 10 to 12 meetings a day over Zoom, where that used to be maybe 2 to 3 if they had to do in-person meetings, traveling. So companies are becoming more profitable. Companies like Zoom are really laying the foundation of this new environment that we're entering into. And when you stay on that same theme, a company like CrowdStrike, which I've talked about time and time again, that continues to rise, I've talked about on Wealth Talk before, they're securing all this. So as a big corporation, if you're allowing your people to work remotely, like we're hearing a lot of big companies may permanently be doing, you have to be able to secure that. And so CrowdStrike is that endpoint security on your laptop that's able to go out and do that. So now you start thinking about companies that are the future, not the past. Companies that are going to continue to have tremendous year over year growth, companies with tremendous balance sheets, companies that are, relatively, in some cases, I was just talking about yesterday on Fox, I was talking about Facebook. And Facebook, when you look at a metrics like price to earnings growth, because remember, growth companies you should pay more for because they're growing faster than value companies. Those companies are actually cheaper than the S&P 500. So would you rather buy the market here, or would you rather buy a company that's the future, is growing way faster than the S&P, has a balance sheet that's better, and is trading at a discount to the S&P? Exactly. You'd rather buy that faster growing company. But herein lies my platform. Here's why I created the Wealth Academy. Here's why I do this every week for free for you, is so you can start thinking more like a strategic investor, more like somebody who wants to build long-term wealth. And that's very hard to do by just following the S&P 500. If you buy the S&P 500 only, and that's all you ever do, yes, it's better than sitting in cash, but what you're doing is guaranteeing yourself that you will always underperform what the stock market's done. Because when you buy the S&P 500, you have to pay an expense ratio. So whatever the S&P 500 does, up 40%, down 40%, you're going to do that minus the fees that you're paying. So today is not the point in time where you want to buy the overall stock market. You want to look for companies like that. Also, just think about some of the names we talked about before. Clorox had a big pullback recently. Procter & Gamble had a little bit of a pullback. Some of these names, if you're somebody looking to supplement your income, I'd rather do that than buy the S&P 500. I'd rather buy companies for my income needs that have better balance sheets than the S&P 500, that are yielding 100 to 200 basis points, 1 to 2% above the S&P 500 to meet that need. So whatever you're looking for in the stock market today, whether it's income, whether it's growth, you have to really, from now on, start doing bottoms up investing. Bottoms up investing means finding individual stocks, then going kind of up the ladder and looking at that big thesis, versus looking at the big thesis and kind of buying the market or then trickling down. You have to do your own research today. You have to be able to analyze stocks, analyze balance sheets, listen to conference calls. And more than likely, you're going to want to partner with professionals that you trust to be able to do that. So that's something you want to look at today. So the biggest headwinds I would think that we're going to be expecting from the market going forward that you need to be aware of is this new strain of the virus. Because even if it does not happen in really some of the numbers that people are worried about, the behavior, the psychology alone of consumers is a big, big concern out there. Also, we know that tax increases are going to be coming pretty soon. We're entering a period right now, August, September, which is traditionally a volatile time for stocks. So that's something you want to be aware of. But look, remember, good investing is counterintuitive. It's going against the herd. It's when people are selling good technology stocks like we're talking about right now that you're buying, when people are bidding up for things just because they can. Real estate prices right now, for example, you want to be able to stay away from that. You want to be able to ring the cash register, but you want to, as an investor now, start looking at the ideas of the future. Look at the ideas that are going to lead us. I gave you a few examples. For those of you who have children, look at some of the games that they're playing, some of the things that they're talking to their friends about. There's ideas out there that are extremely innovative that are not being talked about in the mainstream social media. One thing we talk about all the time is blockchain. What companies are involved in blockchain that you can profit from? One publicly traded company that came out yesterday and reported Coinbase had tremendous numbers. This is a company that's growing faster than the Intercontinental ICE, basically the company that owns the NYSE. So if you are somebody right now who understands what's going on with blockchain, you're starting to understand what's going on with crypto, would you rather own an exchange like Coinbase, that's the future, that's growing faster, that's trading at a discount to what the NYSE is, the New York Stock Exchange, was for all intents and purposes, the amount of stocks that are trading today in 2021 are actually less than they were in 1998. So again, think about growth. Think about using metrics like the price to earnings growth ratio to be able to value those, put them on a level playing field to find discounts. And by all means, if for some reason you're not going to spend the time, don't guess, don't speculate. Buying the S&P 500, if you have 10 to 20 years to put it away, you're going to do better than that. But importantly, educate yourself, arm yourself with the knowledge and ability to be able to create generational wealth. And I haven't been able to find one tool better than the stock market for building wealth for good, disciplined investors over the long term. So I'm Rob Luna. That's Wealth Talk. Today, remember, the stock market is a little bit overpriced, but there's still a lot of opportunity for those willing to do their homework.